All right, guys, welcome back. I hope everyone had a good, relaxing Thanksgiving. So, last 2 weeks, so just hang tough. One more homework assignment next week, Monday night is due. So we left off talking about depreciation before the break. We will spend definitely the rest of today talking about it, and then probably some in next class, and then hit amortization. And then next week we'll get into our last chapter. So, just like I said, hang tight, only 2 more weeks, guys, okay? I wanted to bring up a point. We were talking about tangible personal property and depreciation, and then we got into a lot of the conventions. So there was half-year convention, which is really our standard convention, unless mid-quarter convention applies, right? If more than 40% of our tangible personal property is placed in service during the 4th quarter, then we have to go to a mid-quarter convention. Andre asked a good question after class, and I just want to point it out for everyone's benefit. We had a list, guys, of 3 assets on the board. We had like a new car, some furniture, and something else, a machine, let's say, okay? And only one of the assets was placed in service during the 4th quarter. The other assets were placed in service maybe during the 1st and 2nd quarters, let's say, okay? But because 40% of the value of that asset placed in service during the 4th quarter, it was greater than 40% of the total value of the tangible personal property. Okay, we said we were on the mid-quarter convention. And Andre asked, well, why are we using mid-quarter for everything? Shouldn't just the 4th quarter asset be placed on mid-quarter and everything else be half-year convention? Okay, and the answer is no. And I just want to point this out. If you go on mid-quarter, all of your assets placed in service during the year are mid-quarter assets, okay? Not just the ones placed in service in that last quarter of the year. So even though something might have been placed in service during the 1st, 2nd, or 3rd quarter, it could still be on the mid-quarter convention, okay? You don't just take the assets from the 4th quarter and put those. Again, so if more than 40% of the value of the tangible personal property placed in service in a given year, okay, it's more than 40% of the total value, then all of the tangible personal property coming in during the year are mid-quarter assets, okay? Don't just try to place those from the 4th quarter onto a mid-quarter convention and everything else on half. Just pointing it out, okay, in case anyone else missed that. So, okay, guys. So we started off talking about real property, okay? And it's a fairly similar approach, but it's a little bit different at the same time, okay, guys? And again, you have the summary here. It just kind of just boils it down for you. Real property, guys, for tax purposes, there's 3 types of real property. There's land, which nobody is going to depreciate, right? You cannot depreciate land. And then we have residential real property, which gets a 27.5-year recovery period under the code. And then there's commercial property, which gets a 39-year recovery period under the code, okay? We said for real property, guys, you can only use the straight line method, okay? 200%, the 150% declining balance method are not available for real property, okay? So you have to use straight line. And there's no half-year or mid-quarter convention. It's a mid-month convention for real property. So this means that you take a half a month's worth of depreciation in the month that you place real property into service. Okay, you get only a half a month for that month despite the actual date you put it in service. And for any year that you dispose of real property, you get the depreciation up to date, and then for a half a month for the month you take it out of service. So if I take property out of service on May 13th, I take depreciation through May 15th. Okay, take it out halfway through the month. There are tables in the books, okay? These are based on the straight line, and if you keep the property for the full period, it gives you a half of mid-month for the first month, and it gives you a mid-month for the last month, okay? But if you take it out of service before you fully depreciate it, guys, then you have to go calculate your full year's worth of depreciation and apply the convention manually, okay? The table presumes you're keeping the asset for its full 39-year recovery period, but you may not do so. And when you don't do that, you can go to the table, you can pull off the full year amount of depreciation, but again, you have to manually apply the mid-month convention, and we'll look at that in a little bit. Okay, and that's really kind of what I have up on the board here at this point. guys, and also I pointed out too that there is an extra table in here, table 4. You don't have to worry about table 4 with this 31.5-year recovery period. We're going to ignore that. We're going to pretend it doesn't exist, okay? So for real property, I'm saying here, this is just a little example that we can work through. Let's just assume I bought a rental home on June 1st for $300,000. I made $2,500 worth of minor repairs, and I started renting it out on August 1st. And I want to know, what is my first year's worth of depreciation? Okay? What is my first year of depreciation? Guys, you can use the tables, but of course this is straight line, so you can also calculate manually if you need be. Let's start by saying, what is my depreciation base going to be before we worry about any percentages? What is my depreciation base? You're not going to want to include those minor repairs, right? It's only significant improvements before you place something in service, right, guys? Anything that's a minor repair just to get something in order, you discount that. That's an immediate expensing item. It's only where you're making a significant improvement, extending the useful life of something, that you would tag it on. So here, my starting point would be $300,000. That would be what I would depreciate. This other $2,500, guys, that would just be an immediate expense. That wouldn't be depreciation, okay? Now the question is, let's just assume we're going to use the tables, okay? Can someone give me the appropriate percentage to use? The what? In the book? The table is on 1042. Can anyone give me the percentage? Natalie wins, okay? Okay, guys, it's not the date I buy it, right? You have to be careful. You don't want to start from June 1st, okay? That's the date I bought it, but again, it's based on the date you place something in service. I started renting it on August 1st, so that's when I'm going to start depreciating it. So if I'm going to my table, I'm going to go to my residential table, right? I'm not going to use the 39-year table. I'm going to use the 27.5-year table because this is a rental home. Presumably someone's living in it, okay? I want to go out to column 8, okay? That is the month that I place it in service. And in year number 1, the percentage is 1.364. So my depreciation in the first year, guys, is $4,092. Guys, if you're not comfortable with the tables, again, this is straight line. You could say to yourself, well, $300,000 divided by 27.5 years, okay? Break it down to an annual now. And then you could further divide that by 12 months in the year. And then multiply it times 7.5. Okay? You could, again, it's straight line, guys. So you could say, okay, $300,000 divided by 27.5 years. That would be a full year's amount, okay? You could then break it down, divide it by 12. And since I'm placing it in service on August 1st, right, I'm going to get all the depreciation for January, February, March, April, May, June, July, and then half a month for August. So it's 7.5, okay? You don't want to use the tables. I am going to give you the tables after. But I'm just saying it is straight line, so it's, some people don't like the tables. If you want to use the tables, you will have the tables. Okay, guys? So this is when it's going into service. Now the question is what happens if I prematurely take it out of service? Okay, I don't keep the asset for the full 27.5 years here. I don't keep it for 39 years if it's commercial, okay? Then there's special steps that you need to take to figure out your depreciation in the year you take it out of service. And again, it's on your chart. The notes are summarized here on your chart. And just like with the tangible personal property, guys, the first step is always calculate the full year's depreciation as if you were keeping keeping the asset for the year, okay? So just go figure it out and say to yourself, I'm gonna keep this asset for the full year, and figure out what that number is. You go back to your chart for the month you placed it in service. So here we will go back to August, okay? And figure out, okay, it's year 2, so I should start by multiplying it times 3.636%, okay? Then the rule here says that for whatever month you're taking it out of service, assign that month a number. So if I'm taking it out of service, let's just say in July, that's the 7th month of the year, so that becomes month 7, minus 0.5, okay? Because again, we're on the half month convention. So it becomes 6.5. You could take that 6.5 and divide it by 12. That gives you a percentage. That is the amount of depreciation you're actually allowed. The percentage you're allowed, go back, multiply it times your full year depreciation, because again, you can't have a full year, you're taking it out of service. So take the full year you calculated in step 1, times the percentage that you calculate that you're allowed to have for the year, and that's your depreciation for the final year. So building off of this exercise, okay, the same piece of property that we placed in service in year 1, now we're going to take it out of service on May 7th of year 2, and we want to know what our depreciation is. So what are our steps? We're going to calculate our full year. So you can start with $300,000 again, guys, times what? What's our percentage? 3.636. Guys, and the important thing to note there is, okay, since this went in service in August, you go back to column 8. You scroll all the way back to column 8, okay, and then you go down to row 2 to get your 3.636. This table's easier to use because a lot of the numbers are the same, but don't make the mistake of going to month May, because that's when you're pulling it out, because if you try to do that for some of the other tables, it's going to make your answer wrong. You always go back to the month that you placed it in service when you're calculating the full year amount, okay? So this is $10,909. Okay, that's my full year depreciation, but I'm taking it out of service, so I can't have a full year's worth of depreciation. So step 2 would say, this is step 1, step 2 would say I'm taking it out of service in May. So May is the 5th month of the year. Minus 0.5 is 4.5, okay? Step 3 says take that 4.5, divide it by 12 months in the year, and that equals 37.5%. I'm allowed to take 37.5% of the full year's depreciation. So step 4 just says take that full year's depreciation times the percentage you're allowed, and I am allowed 4,090.88. Okay.
So if it's on like a month thing, does it matter when you sell it? Like, if it were like to be like May 20th or something like that?
No, when you actually, the date you actually take it out of service, it doesn't matter for depreciation purposes. You're taking it out of service on the middle of the month. So it could be May 1st, it could be May 31st that you pulled it out of service.
Oh, so
For depreciation, it's going to stop as of May 15th, despite the actual day during the month.
Got it.
Okay?
Makes sense.
Guys, you good with this? Again, guys, if there's mistakes that are made on the exams, it's the conventions, okay? Don't forget your conventions. These are different than in financial accounting, okay? These are unique to tax, and this is usually where the mistakes are. So know the conventions, okay? Half year, mid-quarter apply to tangible personal property. Mid-month applies to real property. Are we good with this? Okay. Yes.
So, you said for all real property, the only convention that we need to look at is the mid-month convention.
Mid-month only applies to real property. Yep, that's only one you're concerned with. Can't apply mid-month to tangible personal property. And then you can't apply half-year and mid-quarter to real property. So stick with what's on the chart, okay? Okay, guys. So you could be given a list of assets that looks like this. You may be asked, what is the first year's worth of depreciation, okay? And this is a computer, furniture, machine, warehouse, land. What would be the first thing you would want to do if you're given this list of assets?
Real property and personal.
Okay, yes. What'd you say?
What quarter was listed?
Okay. Anyone see anything on here that shouldn't be on here? Land, okay, that would be my first suggestion to you, is get land off your list, because you cannot depreciate land and you don't wanna make a mistake of including it in your numbers, so get it off of there, okay? Then my recommendation would be to assign it recovery periods, okay? So what are our recovery periods for these assets? What about a computer? What's our recovery period? 5 years. What about furniture? 7. What about a machine?
7.
What about a warehouse? 39. Stick with the first one. Okay? Then, okay, once you have your recovery periods down, I would say get your conventions in order. What's our convention here? Sorry? Why would you say mid-quarter?
Yes, you said half a year, you
Alright.
can say.
Here's where I would say, Aiden, you wanna separate your assets. Get the land off first, assign your recovery periods, okay? Then I would say, guys, separate this out, okay? You have tangible personal property, you have real property. You need to deal with them separately. You don't wanna make the mistake of lumping it all together, okay? Our warehouse, okay, guys, the only convention available for this is mid-month, okay? This is mid-month, it's the only convention available. Now, with the tangible personal property, right, we could be on half year, we could be on mid-quarter. What are we on? We're on half year. Yes, we are. Guys, look, this would be my recommendation. You got a list of assets, tangible personal property. Is there anything in the mid-quarter? God bless you. There is an asset in the mid-quarter. I would box it off to draw attention to it as you're scanning your list of assets. Here, however, we are not going to be on mid-quarter, despite the fact that we have this asset placed in service in December, because if you add this up, okay, $15,000 over 140 is not gonna be at least 40%. It's gonna be under the 40% mark, so we're gonna be half year for everything, okay? You guys see why? Yes. We have 3 pieces of tangible personal property. One of them is placed in service in the 4th quarter, so it does raise the concern that there could be the mid-quarter convention applicable. But then what you would say is, okay, $15,000 of the total $140,000 worth of tangible personal property placed in service, 15 over 140 isn't reaching at least 40%. It's gonna stay under. So we're on half year. All of them will be half year. Okay, it's an all or nothing. They're either all half year or they're all mid-quarter. Then they would all be mid-quarter. Okay, but they're all half year here because it's under 40%. Is everyone good with this? Okay. Our methods, guys. Okay, if the problem doesn't tell you the methods for tangible personal property, we assume it's the what? Double declining balance, the 200% method. Okay? And what about for our real property? Straight line. You can only use straight line for that. Okay? So, given that, guys, then you would be off and running to your tables. Okay? You're on half year. You would be looking up my 5-year property computers. Okay? You should find that your percentage is 20%. For your 2 7-year properties, half-year convention, you should find that it's 14.29%. Okay, same thing here. And for the straight line property, if you go to your table, it should be 0.321%. Okay, guys, and then you can calculate from there. Take your original basis times your percentage for year 1. It should be 5,000. So this should work out to $22,396.50. Guys, it is a very reasonable expectation for the exam. You need to be able to work your way through a table like that, eliminate what doesn't belong on there, figure out conventions, okay? Separate real property from tangible personal property, determine am I half year, am I mid-quarter, okay?
What's that below the 14.29?
I drew, 0.321. I drew a line to kind of bring it down.
Oh, the same?
Yeah, same.
Oh, okay.
Take a shortcut, Jared. Okay, guys? Good? Okay, let's look at one problem in the book. This is problem number 52 if you want to follow along. Okay, this is a disposition problem. Okay, these are assets that were placed in service over the past 5 years, and now they're being taken out of service. Okay? They have different conventions, because again, guys, once an asset is assigned a convention when it is placed in service, that convention travels with it for the duration of its life, okay? So you have different assets with different conventions. They're all now being sold, these assets. They're all coming out of service in 2015, and we need to figure out how to deal with these, okay? So it's problem number 52. Does Wade Corporation dispose of the following tangible personal property assets in the current year? Assume that the delivery truck is not a luxury auto, which we'll deal with later. Calculate Wade's 2015 depreciation expense, ignore 179 and bonus depreciation, which we'll talk about soon. Okay, so I put most of the information up here. We have our original basis. What's going to be our first step, okay? In order to calculate the amount of depreciation we can take in a year of disposal. What's our first step for all of these? You have to calculate the full year's depreciation, okay? So let's start with the piece of furniture, okay? We want to calculate, first thing we want to do is the full year of depreciation. What are we going to do for that piece of furniture? All right, guys, it's a half-year asset. It came in as a half-year asset, so it's going out as a half-year asset. It had a 7-year recovery period, so we're going to go to the half-year table. We're going to go to column 7, okay? This is 2015. This asset was placed in service 5 years ago, okay? It was placed in service in 2011, so that would be 11, 12, 13, 14, 15. So this is the 5th year. So we have to go to the half-year table, go to the 7-year recovery period column, and we're going down to the 5th row, because we want to get our 5th year's full year of depreciation. What's our percentage? What is that?
8.93.
Yeah, 0.893 or 8.93. Okay. What about for this first machine? Can anyone come up with a percentage besides Aiden? I'll just answer it. I'll just answer it. Set. Anyone else want to take a stab? Which table are you using, Shelley? Okay, guys, it's a mid-quarter asset. It went in service in the first quarter, so you have to go back to the first quarter table to come up with the full year depreciation. You're scrolling down to year 4. It was placed in service in 2012, we're in 2015, so we would have taken some depreciation in 2012. That would have been year 1, 2013, 2014. This is the 4th year. So you would be going to the first quarter table, the 7-year property, and you're scrolling down to the 4th row, because this is the 4th year depreciation to calculate the amount, okay? What about our delivery truck? What's our percentage? got it, guys? It's a 5-year property. It's a half-year convention. So we're going to the half-year table. We're going to the 5-year column. It was placed in service 3 years ago. So we're going down to year 3, right? We took some depreciation. Its first year was 2013, 2014. It's now 2015. So we're going down to the 3rd row, okay? So it should be 19.2%, okay? What about our second machine? Bingo, okay? Can everyone find this? 27.55, guys. Don't do what most of us wanna do and go to the 4th quarter table, because that's when we're taking it out of service. That would be wrong, okay? It came in, well, actually, sorry, I'm looking at the wrong one. Don't go to the 3rd quarter table, because that's when we're taking it out, okay? You wanna go to the 4th quarter table, because that's when it came in. You wanna go to the 4th quarter table, you wanna go to the 7-year column, okay? And you wanna go down to row 2, because this is its 2nd year. We placed it in service last year, that would have been year 1. We're taking it out of service in 2015, that's year 2. Again, we're calculating the full amount right now, the full depreciation for year 2. So it'd be 27.55. What about this last one?
And depreciate, right? Those
You're
government-
absolutely right, okay? You're not getting any depreciation on that, why not? That's exactly right. We placed it in service and took it out of service in the same year, okay? You get 0 depreciation on that one. So it's nothing. So I'm just writing down now, guys, what the full year's depreciation would be, okay? Okay, but we can't have this full amount of depreciation, okay? This is the full year's calculation. You can only have some of this. And again, that's gonna depend on, was it a half year, was it a mid-quarter, and when did we take it out of service? So for this first one, what do we wanna do? This is our full year amount. How are we gonna get the actual depreciation we could take this year? Don't overthink this one, guys. What's its convention? 50%, half year. Okay, so divide it by 2, multiply it times 50%, whatever you want to do. It's 2, 4, 5, 5, 7, 5. Okay, we're going to do the other thing, same thing for our other half year asset. Which will leave us with 1920. Okay, what about this one? This is our full year amount. It's a mid-quarter asset, so we have to use a mid-quarter convention, right? Came out of service on 3/15, guys, right? That's the first quarter of the year, so we can only take 1.5 months worth of depreciation this year, right? It's coming out of service in the first quarter. You can only get 1.5 months worth of depreciation. Yes, it actually came out of service on March 15th, but for depreciation purposes, we assume it comes out of service on February 15th, because that's halfway through the first quarter. So you could say, divided by 12 times 1.5. You got that, Jared? Okay, you could take the full year number, divide it down by 12 to come up with a monthly amount, and then you're allowed 1.5 months of depreciation, so times 1.5. Okay, that'll get you to your 98,370. What about this one? Look, guys, we're gonna divide it, look, it's a mid-quarter, okay, it's a mid-quarter. So, we can only take, it came out on August 15th, but we're gonna assume it comes out of service on, actually it'll work out to be August 15th, it actually will be August 15th. So it actually came out of service on August 15th, but that's the date we would have picked anyway, because that's midway through the third quarter. August 15th is in our third quarter. And when you take a mid-quarter asset out of service, okay, you take it out midway through whatever quarter you're actually pulling it out of. So here it works out that it's actually 8/15. So you're gonna get 7.5 months worth of depreciation. You're gonna get all of quarter one, which is 3 months. You're gonna get all of quarter two, which is another 3 months. And then you're gonna get half of the third quarter, which is 1.5 months. You're gonna get 7.5 months worth of depreciation, right? So again, guys, you could say divided by 12 times 7.5 months you're allowed. That should work out to 46, 490, 63. This was 0. Okay. Guys, that one's confusing. It wouldn't make anything that long and tedious, but you should be able to work through those individually. Okay. If you're not understanding it, let me know, because we can walk through it.
With the mid-quarter, doesn't it just have, like, actual percentages for the quarter?
You could memorize the percentages if you would prefer, absolutely, but that's the same philosophy. It's the same thing. If you like take that 7.5 divided by 12, it'll give you your percentage. So yes, if you're more comfortable memorizing the percentages, by all means. But if you're easier to just say to yourself, you know, how many months you're allowed, then it's the same thing. Okay? Okay, guys, moving forward. The book touches on this concept versus allowed versus allowable. I'm going to go into it a little more than the book does. Guys, you don't calculate depreciation just for purposes of taking a deduction, okay? You also use depreciation to keep track of the value of your asset. So you might acquire an asset with an original basis, guys, but as we take depreciation and as that depreciation accumulates over time, right, the adjusted basis of our asset continues to decline. And when we go to sell that asset, okay, it's not going to be worth this $55,000 anymore. It's going to be worth something less than that, okay? So we use it to calculate current year's depreciation, but we also use it to keep track of the value of our assets, okay? There is a code section 1016, guys, and this code section deals with how to determine your adjusted basis. Now within this code section, there is this allowed versus allowable rule, okay? And what this rule basically says is that despite what you actually took for depreciation purposes, what you just calculated and took on your tax return, you have to deduct, you have to reduce your adjusted basis by the greater of the amount allowed or allowable. In other terms, this means that you have to reduce the adjusted basis of your asset by the amount you actually claimed on your tax return, right or wrong, okay? You might not have selected the right amount. You might have deducted something incorrectly on your tax return, but that is your amount allowed, what you claimed on your return. Or, if bigger, the amount allowed, the amount allowable, sorry. Okay, the amount allowable, guys, is the amount you should have claimed based on your cost recovery methods, okay? That's the amount you should have appropriately deducted based on the cost recovery method. So, despite what you actually did, right or wrong, the rule says you have to reduce your adjusted basis of your asset by the amount allowed, what you claimed on your return, or the amount allowable, what you should have deducted, okay? So, why is this rule out there? Okay, guys, there's some times where taxpayers forget to book an asset. Maybe they didn't tell their tax accountant that they bought an asset, so the tax accountant doesn't take any depreciation, okay? A mistake was made. There's other taxpayers who purposely think they're gaming the system and don't tell their tax accountant that they bought a big barn this year because they're saying, you know what, we don't need the deduction this year. We're going to save it for another year. When I really need that deduction, I'll start depreciation then. Little do they know that you can't do that, okay? And they don't know that this rule exists. There's also other taxpayers who maybe are more tax savvy who say, you know what, I don't want to get caught up in the recapture rules, which we're going to look at more in the next chapter. So there's different reasons that taxpayers, whether it's mistakes or whether it's on purpose, that they may or may not take depreciation deductions, okay? And what this rule says, guys, in so many words, is that even if you deduct absolutely no depreciation, okay, the value of your asset in the eyes of the IRS is still going to be reduced by the amount of depreciation you should have taken, okay? Alternatively, guys, if you took too much depreciation, maybe it was a mistake, okay, you booked too much on your tax return, you're gonna reduce the adjusted basis of your asset by that amount. Okay, so here, where did I put this? Okay, here. Say I bought an asset of, for $100,000, okay? And based on the cost recovery methods I have in place for my other assets, okay, and the elections I make, my cost recovery method says that I should deduct $20,000 a year. I'm gonna depreciate this asset over 5 years. I'm not applying convention, guys, so don't come back and say, oh, it should be $10,000, I know. This is just for simplicity, okay? My cost recovery method says $20,000 a year for the next 5 years is what you should do. What if I deduct absolutely nothing, okay? I don't tell my accountant that I bought this asset and he takes no depreciation, so no depreciation gets deducted on my tax return, okay? What does that mean for my adjusted basis of my asset? Okay, what it means is that I have to reduce the adjusted basis of my asset by the amount allowed, which is 0 here, right? I didn't take a deduction. The amount allowed, again, is what I report on my tax return, okay? So the amount allowed here was 0, or the amount allowable, okay? And that is based on my cost recovery method, okay? My cost recovery method says I should have deducted $20,000. So even though I didn't actually take any depreciation expense on my tax return, in the eyes of the IRS, I have an asset worth $80,000, okay? If I deducted $25,000 erroneously, I shouldn't have, but I did. We made a mistake calculating, okay? This means that I have to deduct the greater of $25,000 or the $20,000 under my cost recovery method. So here, my $100,000 asset is now worth $75,000. With me so far? Now guys, if you think back to our statute of limitations, okay, this is like the second chapter of the book, I think we covered statute of limitations. Typically, our statute of limitations is open for 3 years, okay? If you catch your mistake, you can of course go back and amend your tax return, maybe for up to 3 years, okay, depending on timing. You might be able to go back and correct your mistake for 3 years. So you can go back and file a return, claim the appropriate $20,000 in year 1, claim the appropriate $20,000 in year 2, etc., okay? But if your statute of limitations is closed, you have a bigger problem, okay? Now you can't go back and amend. And what you cannot do is you cannot just come in and say, oh, look, I'm just gonna do a catch-up adjustment. I'm gonna book it all this year, okay? So kind of going over here, sorry, this is a bit messy and crowded. So you may be tempted to say, look, I should have booked $20,000 in year 1, I forgot. I didn't do it in year 2, we forgot. So I'll just book $60,000 now and I'll be whole, right? No problem. And I'm gonna turn around, I'm gonna sell this asset for $40,000, what it's kind of worth today. And I'm gonna subtract off my new adjusted basis. I started with an original basis of $100,000 minus the $60,000 of depreciation I took. And that means I have 0 gain or loss, okay? But the allowed versus allowable rules, guys, are gonna change this result because what's it gonna say?
With the 40,000 come from?
I just said my cost recovery method, I would tell you that. My cost recovery method based on the elections I have in place, based on the other types of assets I'm placing in service would have determined what my cost recovery $20,000 was.
No, the 40,000.
This?
Right.
I'm just saying this is what it's roughly worth now. Okay? But what would have happened here, guys, is, okay, I didn't actually deduct anything, but under the allowed versus allowable rule in the eyes of the IRS, my allowable was still $20,000. So I might have started off with an asset worth $100,000, okay? But in the eyes of the IRS, after year 1, my asset would have only been worth $80,000, right? Same thing in year number 2. They would have said, the IRS came in at that point, they would have said, no, we know you didn't deduct anything, but the allowed versus allowable rule is in effect, and we still are gonna pull $20,000 off, so your asset is now only worth $60,000, okay? Come year 3, well, I did a catch-up entry, okay, and I took $60,000 worth of depreciation to make myself whole. But here, right, I have to select my bigger number under the allowed versus allowable rule. So now, in the eyes of their IRS, I have an asset worth 0. So if I go to sell the asset under their terms instead of what I think it should be, all of a sudden, I have a $40,000 gain, don't I? Okay? So what I thought was a 0 gain, I thought I kind of washed. The IRS comes in and looks at the allowed versus allowable, what you should have been doing versus what you actually did do. You might end up, in fact, with a gain, okay? And this does happen. Because you should have been taking these deductions all along. And again, you can't make this catch-up entry. Now guys, there are rules out there that might alleviate some of this. I don't want you to think every taxpayer is stuck if they screwed up. You can apply for a change in accounting method. But first of all, we don't like to do that because we're drawing attention to ourselves. And second of all, it's not always gonna work, okay? So just realize that this allowed versus allowable rule is out here. And the fact is you have to make these adjustments, okay? And whether or not you're gonna book depreciation, the basis of your asset is being reduced every year by what you either booked or what you should have booked, whatever the bigger amount is. So when you go to sell something, your basis may not be what you thought it was, okay?
Confused how you go from 60,000 to 0.
Because the allowed versus allowable rule says in the eyes of the IRS, you have to reduce the adjusted basis of your asset by the bigger of what you actually deducted on your tax return or what you should have deducted under your cost recovery method. Well, under my cost recovery method, I should have deducted $20,000 each year. Okay, but what I did is I screwed up my first 2 years. I forgot to take depreciation. So in year 3, I tried to catch up. But at the end of each year, the way the IRS would look at it is say, okay, you started with this asset worth 100. Year 1, allowed versus allowable. Well, you didn't deduct anything, but you should have deducted 20, so you're down to 80. Year 2, you're down to $60,000. Year 3, allowed versus allowable rule says the greater of the two, what you actually deducted on your return or what you should have deducted, so I'd have to pull 60 off my basis here. And all of a sudden that asset becomes worth nothing. Okay? Okay, guys. That's basic maker's depreciation, okay? Modified accelerated cost recovery depreciation. Now, and again, this is all summarized on the handout, guys. If you can handle what's on the handout, then you should be good. Now, in addition to basic maker's depreciation, guys, Congress currently has in place 2 other depreciation provisions, okay? And these provide immediate expensing of depreciation. Now, they use terms in here like bonus depreciation. I don't want anyone to think, guys, that this is depreciation above and beyond what the asset is worth. All these provisions are doing is allow a taxpayer to accelerate depreciation, but they're not actually granting them more depreciation than they would otherwise be allowed, okay? They're just simply allowing a taxpayer to pull forward their depreciation. And again, this is one of the few areas where the IRS is fairly generous with expensing. Typically, the IRS wants us to slow down expensing, but in the depreciation arena, they're actually allowing us to do us much quicker. And these 2 provisions are another example of how they're allowing us to really pull forward our deductions, which normally they don't let us do. Okay? Let's look at 179 first because they are a little bit different. In the case of 179, actually I should say, guys, both of these provisions, bonus and 179, these are elections. You do not have to use these if you do not want to, okay? Most of us will want to because we're gonna want to pull forward our deductions, but you may have reasons not to and you don't have to, okay? These 2 provisions, guys, only apply in the year you place an asset in service. If you don't use it the first year, you don't get to go back in the second year and say, oh, I'll use it now, okay? It applies in the year you place assets in service only. Now, 179. okay, I'm just looking at 179. 179, guys, applies to new or used property. New or used tangible personal property. Don't worry about the provision in there that talks about it also applies to real property. We're going to ignore that, okay? We're just going to focus on the tangible personal property. Okay? And it allows, guys, a business to pull forward up to a maximum of $500,000 of depreciation on this tangible personal property. There are limitations on this, of course, okay? 500,000. Okay, so this provision initially says that you can pull forward $500,000 worth of depreciation on tangible personal property you place in service in the current year, okay? But this provision, guys, was designed really to help out smaller businesses. This isn't geared towards your bigger corporations and businesses. This is geared towards a smaller company. So if you place in service more than $2 million worth of tangible personal property, they are starting to deem you to be a little bit bigger than they wanted you to be. So what they do is they say, to the extent you place in service more than $2 million worth of tangible personal property, they start to reduce that $500,000 on a one-for-one basis. Every dollar you go over the $2 million, they pull back $1 off of the initial $500,000 election they provide you. Okay? How does that play out? So look, initially they say you can pull forward $500,000 worth of depreciation on tangible personal property. But if you go over the $2 million mark, okay, you have to start to reduce that $500,000 election. So here, I have a company who placed in service $2.3 million worth of tangible personal property this year. Okay, they went over the $2 million trigger. So what this rule is says, take that $500,000, they placed in service 2.3, which means they went over the $2 million mark by $300,000, right? So the 500 is reduced by the 300 they went over to. So they are only allowed a maximum election of $200,000. Their $500,000 just became $200,000. That is the maximum election under 179 they can make. And I want to point out, guys, that this limitation provides you an election, okay? This does not guarantee you a $200,000 deduction. This just simply says that your company can make a $200,000 election to accelerate depreciation by $200,000, okay? It's not guaranteeing you a deduction, this limitation, okay? The other $300,000 that we were denied here, it's gone, okay? It goes away, this $300,000. It just says that you are allowed $200,000 because we're a little bit bigger of a company than they really intended this deduction for. If we reached $2.5 million of assets placed in service, you'd be denied this provision altogether because now you're just outright too big and they don't want you to have this, okay? Now, the second limitation, guys, okay, there's a second limitation on this. And this one says that, look, you can take this election and you can actually deduct it, okay? Because this just provides you an election. The second limitation actually tells you how much you can deduct. It says you can take your election and you can actually deduct it to the extent that the business has taxable income available to you after all other expenses, including our basic maker's depreciation. Everything else has been deducted except for 179. Then you look at your taxable income and you see how much taxable income is available to you, okay? And then you can make your 179 deduction. So you can take 179 up to the extent that there is taxable income available to you. You cannot create a net operating loss with 179, nor can you contribute to a net operating loss by deducting 179 depreciation. You can only actually deduct 179 to the extent there's taxable income available after all other deductions have been made. We'll look at a couple of problems. Okay, a couple other points here. Okay, to the extent of this one, guys, if you are denied a deduction because you don't have enough taxable income available, here, let's say I have an election of $200,000. Let's say I only have taxable income of $100,000. I would only be able to deduct $100,000 of my $200,000 election, okay? The other $100,000 I can carry forward indefinitely, okay? Again, we'll look at some examples. But here, with this second limitation, you can carry forward the portion that you were denied use of, okay? Our first limitation determines an election amount. The second limitation determines what you can actually deduct. If you can't deduct your full election, you can carry it forward.
That's after you already deducted the $300,000, that's gone.
The $300,000, this is gone. This is just helping you determine the amount of the election, okay? And any unused election, that $300,000 unused election, that disappears. So then the second limitation says, okay, I could possibly take $200,000 accelerated depreciation. But now I have to look to my taxable income. Do I have enough taxable income available to let me take this full $200,000? I don't. I only have $100,000 of taxable income this year. So I can only use $100,000 worth of my election. The other 100, in this case, I can take forward with me to next year, okay? Okay, guys, general notes here. You can pick and choose what assets you want to put 179 towards, okay? You can pick and choose the assets you want to place 179 against, okay? The general rule says that if you want to maximize your depreciation deductions, which we usually do, you come up with your percentages, okay? After you determine your conventions, you select the item with the smallest percentage amount, okay? That's the general rule. You're going to target the item with the smallest percentage in the current year. You're going to see there's two places we're going to change that rule, okay? Percentage. So determine your conventions, come up with your percentages, and then you're usually going to target the one with the smallest percentage to apply 179 against. Okay. And then the other rule says, guys, look, if you're going to use 179, you have to reduce your adjusted basis by the amount of 179 depreciation you're accelerating before you can go on and calculate your make-use depreciation. So you start with your original basis, you subtract 179, you come up with a new basis, and then you calculate makers. So it's 179, then makers. You have to work in order. Okay. What I want to point out is here. So you could have a couple of assets, okay? Let's just say this is a machine, let's say this is furniture. They both have 7-year recovery periods. They were both placed in service on December 1st. One is worth $540, the other is worth $75. Okay, guys? These are, sorry, this is supposed to say 2-1. That's not supposed to say December 1. Okay? Right now, if you look at this, we would be on the mid-quarter convention, right? Because this asset was placed in service in the 4th quarter, 540 over the combined 615, guys, is like 88%. So right now, we would be on the mid-quarter convention. And if I went to my tables for these, those would be my percentages. Now, I just told you that you usually want to target the lowest asset, okay, the asset with the lowest percentage, to apply 179 against. So, assuming I was allowed to take all $500,000, I'm going to pull my 179 off of this asset because it has the lowest percentage. Okay? So I would come up with a new balance. And this would leave me with $40,000 and $75,000. Now, at this point, I would calculate my maker's depreciation, what we've done up until now. Okay? The point I'm making here is, guys, when you get to this point, you have to reassess your conventions. Because we were on the mid-quarter basis, but if you look at this now, we're no longer gonna be on the mid-quarter convention, okay? We are now gonna flip over to a half-year convention. 40 over 75, guys, is only 35%. It doesn't reach 40%. So after you take 179 off of whatever assets you're gonna take it off of, you come up with a new balance. At the point of this new balance, reassess your conventions because they might have changed, and in this case, they will. Okay, so instead, we're actually gonna be on a half-year basis. New convention, now I'm on a half-year, now I'm on a half-year. If you go to your tables, 0.1429, 0.1429. The numbers themselves aren't important. I'm just trying to draw your attention to the fact that you might start on a mid-quarter, okay? But by taking 159 off of the asset, 179, sorry, you might have just flipped your convention over. You with me? Sorry.
So for the first year on the second asset, you would take the mid-quarter.
For the second asset? No, actually, they would both become half-year when you're calculating makers. The rule says that you look at your conventions after the application of 179. But in order to figure out which asset you want to target for 179, you have to start by looking at conventions, because again, you want to see which has the smallest basis, because the idea is you want to maximize depreciation. Well, an asset with only 3.57% is going to give you less depreciation than an asset with 25%. So the general rule says target that. So you have to start by looking at conventions, but again, your conventions may be affected by your choice of assets under 179. Good? Good.
Professor?
Yes.
So for the percentage for mid-quarter for the furniture, you would go, to the first quarter?
Nope. After the application of 179, it changed your conventions.
Okay.
So you started here, but then you come up with a new balance. This is your 179 depreciation would be $500,000. Now you're left with only $115,000 worth of assets. You reassess your conventions for all assets. So now it would be half-year for both of them. Okay? Good? Okay. Guys, there's a portion of the book in here that talks about what happens if they don't renew the 2015 elections. We're going to ignore that. The election drops from $500,000, I think, down to $25,000. Let's disregard that. Every year they seem to vote on this, like the first week of January, and they make it retroactive to the beginning of the year. More than likely, they will do the same this year. As of last night, they hadn't voted on it, and again, they probably won't do that until January. So we are going to assume that the $500,000 and the $2 million and the $2.5 million thresholds stand. Okay, don't worry about the blurb that says, you know, it'll only be $25,000. It's a possibility, but probably not a strong one. So, okay. Let's look at problem 56 in the book. Okay. For problem 56, we said, assume that TDW Corporation has a 2015 taxable income of $650,000 before 179 expense. Okay, so they're telling us corporation has taxable income of $650,000 after they've deducted all other depreciations, including their maker's depreciation. They have not yet deducted 179. They're not sure how much of it they can actually claim. That's the last thing that comes off, okay? And they acquire the following assets. They want to know what is the maximum amount of 179 that they may deduct, and what is the maximum total depreciation. So we have a corporation, and it has taxable income of $650,000 before. Okay, this is important because this changes a little bit down the road. Before 179 has been deducted. Okay, so they haven't deducted 179 from that figure yet, but they have deducted maker's depreciation from that number. That's what they're trying to tell us. Okay, and They've got a machine, a computer, and some furniture. And guys, our recovery periods are 7 years, 5 years, and 7 years. I'm adding those in. These were placed in service on 10/12, 2/10, and 4/2. And right away, if I were you guys, I would be boxing that off because it's a fourth quarter asset. You should be wary of those fourth quarter assets. They may affect your conventions. Okay? And they tell us that they are worth this amount. Okay, guys, I'm obviously on the, what convention? Mid-quarter, right? 12,270,000 over 2413 is 52.6, so I'm on the mid-quarter convention. So if you go to your tables, you should find these percentages based on the dates these assets were placed in service. Now they want to know what amount of 179 can I claim? How much 179 can I deduct? 87, said that again.
Yeah.
Okay. 87. You guys see why it's 87? Okay. This is these are all tangible personal property. Okay. Be wary, again, if there's real property on here, you pull it out when you're making that $2 million calculation. But we placed in service, guys, $2.413 million worth of assets. That's more than the type of company they were targeting for this, right? We went over the $2 million limit by 413, so we have to reduce the $500,000 initial election by that 413. That leaves us with a maximum election of $87,000, okay? We have an election, maximum amount, $87,000. Doesn't mean we can deduct $87,000. It just means we might be able to deduct 87. The other 413, guys, is gone, okay? Once you can't make use of that election, the election is gone. We can maybe take $87,000, okay? What's our second limitation that we're looking at now? So we know our election is 87, not 500. Now what am I looking to? I'm looking to my taxable income. Okay, we have lots of taxable income. Okay, even if he had only placed in service $1 million worth of assets and we were allowed to take $500,000, we would have been able to deduct all $500,000 because that would not have created an NOL, right? So 87 will very comfortably fit, be a deductible from 650 without creating a loss. So we're good here. So we're going to take $87,000 179 deduction. Where are we going to take it from? We're going to take it from the first machine because it has the lowest percentage this year. So we're going to take $87,000 off of this guy. Okay? Then we're going to come up with a new balance. This comes down to 1183. And then the other assets remain the same. What do I want to do when I get here? You want to see if your convention changes. You need to recalculate, okay? It doesn't here, guys. We're still on the mid-quarter. If you take the 1183, our fourth quarter asset, over the total tangible personal property, it works out to be 50.85%. So we're above the 40% mark. So we're still on mid-quarter convention, okay? So these percentages are still applicable for this problem. We're good. So if you work those out, guys, it's 42,233, 92,050, 157,080, plus our $87,000 is part of our overall depreciation number. So tack that on. You should end up with depreciation of 378,363. Good. Are you guys able to see if I do it here? The next one? No? Can you see? let's look at 57. Assume that Timberline Corporation has 2015 taxable income of $240. Okay, guys, right away you have to be worried. Okay, taxable income. Once it's not $500,000, you may not be allowed to use all of your election. Okay, and it gives us a bunch of assets, and it basically wants us to answer the same questions. What's our maximum 179? So here we have a corporation, and they have taxable income of $240K. Okay, again, guys, before they made any 179 deduction, they deducted everything else except for 179. They have furniture, they have a computer, they have a copier and a machine, and they placed them in service on December 1st. And they tell us okay. What convention am I on? Half year. Okay. Yes, I have a mid-quarter asset. I looked fourth quarter asset, guys, but 350 over 950 doesn't get to 40%. So all of my assets are half year assets. So my convention is half year. And if you look up the percentages, now I want to know what 179 deduction I can take. Okay? What election can I make? What 179 election can I make? You can make a $500,000, right? $500,000 is the most. It gets limited only if the total of my tangible personal property placed in service goes over $2 million. It's not going over $2 million here. So I can elect $500,000. It doesn't mean I can use $500,000. It means I can elect $500,000. Okay? But I have a limitation here. My taxable income, okay? I can't take a deduction of more taxable income than I've got available. So my $500,000 election, okay, of it, I can use 240. The other 260, guys, I can pull forward to next year. I can carry that over next year, okay? This year I can only use 240. Where do I want to use it? Okay, this is gonna change my general rule.
You divide it between
You don't, okay? The general rule here says apply it to the fourth quarter asset, okay? Because this may get you out of mid-quarter convention, okay? This may help you avoid the mid-quarter convention. So, because what happens, Jared, if I applied it, let's just say here, to this other asset, I may force us inadvertently onto the mid-quarter convention. I don't want to do that. I want to avoid it if possible. So if you have a choice of two assets with the same percentage, but one of them is in the fourth quarter, apply it to that asset so that you don't force yourself onto mid-quarter. Okay, so here we're going to take that 240 off of the first asset, the fourth quarter asset. Okay, I'm going to come up with a new balance. Okay, 710. Guys, I wasn't on mid-quarter before, and I reduced the amount of that mid-quarter asset by taking this off of there. So I'm definitely not going to be on mid-quarter now. But again, reassess, do the right thing, check yourself. But we're still going to be on half-year convention here, okay? So these percentages for this particular problem will still work. They might not always. Again, you might have to check, and you might have to change your percentages. But here, we're good. We can still use the same figures that we started with. So what is my acres depreciation? You're going to take the 110 times the 0.1429, so on, etc. So and then don't forget to add this to your total depreciation number, because it is part of your depreciation. Okay? That should be your number for the year. You guys good with us?
Wait, why do you add 249?
Because it is depreciation. So if I asked you, Henry, what's your total depreciation for the year? You would take the 179 depreciation plus these figures here are our maker's depreciation. Okay? But I could ask you, what's maker's depreciation? Well, those are your maker's depreciation figures. What's your 179 depreciation? That's 179. Combined, that's your total depreciation. Okay? This is standard makers, which they've already, which is kind of backwards, but they assume it's already come out of this number. Okay? And then this is 179. But all together, it's depreciation.
Carry forward the 260, the rest of the 500,000.
Well, again, you were allowed the full $500,000 election because your assets didn't go over $2 million. Now again, that's just an election. You're not guaranteed to use it. And here, we couldn't use it because we don't have enough income available. We can use 240, the other 260, you pull forward into next year. And hopefully, you can use it towards your depreciation figures next year.
Okay.
Yes. Again, it's not a guarantee, but they say you can carry it forward until you can use it.
Okay.
Okay? And I'm not gonna worry about the calculations for next year, let's just figure this out.
Okay.
But yeah, you can carry forward 260.
Okay.
Okay, guys? Let's get through one more of these. Okay, you guys get this, but the problem, the same problem, before I jump over to the next one, guys, says that what would have happened if I made this, disregard what happened over here, $2 million instead of the other number. This, okay, look guys, I mean, it just means that I'm over $2.5 million. Once you're over 2.5, you can't take the benefit of 179. So I would have had no deduction here. And basically, you were just going to work your maker's numbers off of the original balances, okay? 179 wouldn't have applied. You would have just done makers like you always do makers, okay?
You would have said it half year?
No, you wouldn't have been happier. You would have changed to mid-quarter, right? Because your fourth quarter asset over 2.6 would have been more than 40%. So no, these numbers would have been mid-quarter percentages instead. But the point they're driving at is that, look, 179 isn't going to apply. You can't accelerate your depreciation. Let's hit number 58. We can bang through it quickly. 58. We have Dane Diamond Bit Drilling purchased the following assets this year. Assume its taxable income for the year was $53,000 before 179. Okay. So they are very low taxable income. Half year, mid-month. Guys, just don't get sucked in, okay? There's real property in here. You gotta be careful when you're doing 179 bonus mid-quarter, right? Always separate out your real property, okay? Nothing here was placed in service in the fourth quarter, so we're okay. But again, you see real property on your list, you have to look at it differently. The problems are all addressing tangible personal property. So, we're half year, right? Nothing was placed in service in the fourth quarter, so we're half year. And real property, guys, is always mid-month. So if you go to your percentages, this is what you will find. Okay. This totals, I didn't have a total, okay? What election can I make for 179? I can make a $500,000 election, because I only have $185,000 worth of tangible personal property. We're not even close to $2 million. So I can make a $500,000 election. What amount of deduction can I make? $53,000. If I take anything more, I'd be creating an NOL. So I'm gonna take $53,000, okay? This problem becomes, where do I deduct it from? Whichever one I want. Okay, guys, definitely, look, this is the lowest percentage, but don't apply it to the real property, right? You can't do that. This doesn't apply to that. And I have these, guys, I have drill bits. Neither one's in the fourth quarter, so it doesn't really matter. I can take them against one or two. I could do half of each, doesn't matter. I'm gonna take $53,000 off of this one. Okay, that's gonna leave me with a balance of $37,000 here, $95,000 there, $220 there. I'm gonna calculate my acres. That's 4002. And again, I'm gonna bring this over to add it on to my total depreciation. It should be 83,402. Bigger purchase, actually. Alright guys, so the second part of this problem, you guys seem to have this down, guys, okay? Again, on 179, there's two limitations to appreciate, okay? The first thing you're looking for is how much tangible personal property was placed in service. That determines an election, okay? It doesn't guarantee you a deduction, it gives you an election. Any election, if you have to reduce the $500,000 because you went over $2 million, that election disappears, never to be seen again, okay? After you determine your election, you're looking to the taxable income available, okay? You can only deduct up to the amount of taxable income available, okay? If you can't use all of your election this year, you can carry forward the unused portion to next year. We'll hit bonus next week and we'll finish the chapter on Thursday. I will see you guys then.